Hey folks, welcome to this conversation on Business Redefined, your weekly, most comprehensive look at the world of business, finance, and economics. Tonight, we want to talk about matters real estate investment trust, and the latest licensing issued by the Capital Markets Authority is to be Vida, and we are privileged to have Sam Kariuki. I interviewed this gentleman 2 years ago. Sam, karibu sana.
Asante.
It's been a long time, man.
No, it's a pleasure to have you here.
Nashukuru
It's
sana.
been a busy period for you.
Oh yes, indeed. Sam, in our debut conversation 2 years ago, I asked you about your capital raising options and specifically whether going the REIT's way was on the table. There was no commitment at the time. A lot seems...
And I thought, watch this space and see what is happening now.
Yes.
Yes. 2 years is a short period for business.
Just walk us through how you got to this point.
I think if I look at real estate generally and residential specifically, I've always had a passion. I've always felt it's important capital markets, Kenyan capital markets, have a role in it. And even in my previous life, you know, I initiated certain issuances to try to realize that. And even though I was non-committal when we first met, I think deep in my mind I knew for you to grow, for you to address what I see as a very large market opportunity, your own capital isn't enough. At some point, there has to be a capital market play. And I've always thought the asset class is very, very attractive. The market opportunity is very significant.
I see. So help me understand this, because when I look at the announcement from CMA, it looks like you are structuring a D-REIT, a development REIT. When you look at the market, what we have currently, one player has an investment and D-REIT concurrently, and another one has gone through a restructuring, trying to get back. Walk us through what you are going through now.
I think globally, most REITs tend to be I-REIT, income REIT, and I think that's a very typical class. D-REIT is almost very specific to us. Even in Kenya, I think other than the Econ D-REIT, all other REITs have been structured as I-REITs. And the Econ D-REIT, in a way, the end play is an I-REIT because it exits the assets to an I-REIT. The eventual return is the rental yield from student housing. We do not have yet a specific REIT whose underlying is housing. So we don't have a housing REIT. If I look at housing specifically, beyond the market opportunity, a development for sale play has very significant returns. The experience of private players in that is because you're able to use a very small amount of equity to mobilize a lot of deposit and construct. Your project IRR is multiplied several times from an equity IRR perspective. And the question has then always been, why then shouldn't you use whatever you have, your capabilities, your own capital, to crowd in local capital, bring in pension money, which is, you know, the primary source of local capital. And you can then, on one side, as a developer, you grow, but also the pension funds get to make several times more than what they like to make in government bonds. Yes. So I think the market is ready now for development REITs, and specifically development REITs that speak to development to the housing agenda generally.
I see. So Sam, this sounds pretty unique to me in the sense that it looks almost like you are structuring a REIT which has a redemption option baked into it.
Yes.
Why is that?
I think a number of things. You know, we were having a discussion earlier on why REITs have seemed unattractive. And they haven't done as well as we would have envisaged or relative to our peer in Africa, in this case, South Africa. One of the issues has been the trading at the stock exchange, the almost absence of a secondary market. If I'm investing in a REIT, I almost, as an investor, I would feel like my capital is now being held permanently with no, you know, practical exit options because of the dynamics around secondary trading. Now, a development for sale and specific to housing is unique. It's unique because the asset itself is self-liquidating. When you sell a housing unit, by the time a customer pays everything for that house, you've returned your capital, the capital invested in that house, plus a profit. And I think then there's an opportunity to create alternative exit mechanisms for investors by giving them the opportunity or the option to redeem that capital. So it's almost like a a put option, or a call option, yeah. So you can redeem that capital. And the only thing that you've done there is to give them an alternative exit mechanism and almost give them an assurance that your capital is not permanent. Within a 3-year cycle, a project takes about 3 years. A typical 3-year cycle, you should be able to get not just the dividends from a particular phase of a project, but also the capital back, should you elect not to roll it over into a new project.
I see. Interesting.
And I think it also enhances IRR because you might make very good profit at a project level, but the more you drag, the more you hold the capital, the more then you start eroding and drag. There's an IRR drag whenever you hold a lot of the capital for a long time.
Sounds to me like you're on a mission to diversify your sources of capital. How does your project pipeline look like?
It's significant. I think if you look at the market opportunity for housing, I've always found it curious, people commenting about potential bubble. But I think that view does not reflect urban dynamics globally in Africa and specifically Kenya. Africa is urbanizing at a very fast rate. Hundreds of thousands, if not millions, moving into cities to look for jobs. The demographics support long-term sustainable urban growth. If I look at what drives demand today, it's very deep and long-term demand, especially for quality, affordable rental. So as long as there is demand, deep demand for rental, there will always then be deep demand for housing. The offtake mechanism, whether it's retail or institutional, notwithstanding. The question, and the government estimates 2 million units deficit. Maybe it's not 2 million, but I would estimate it in my head a deficit of hundreds of thousands in Nairobi and now the other 4 cities. So if you, that's one angle. The other angle is it's a very fragmented market. I don't think any player, including ourselves, holds or controls even 0.1% of the market. It just tells you then there is capability for scaling up, institutional players scaling up, doing 5,000, 10,000 or so. So our assessment is that the market opportunity is very significant, targeting retail investors and institutional investors who can then hold to rent out. So far, we've been funded by private equity capital. And therefore, the 840 or so units we've constructed or are constructing here at Garden City and in Iruta have been fully funded. They are doing well. First phase was completed. The next phases get completed next year. But over the last 2 years, we've developed another pipeline of about 3,500 units here at Garden City in the next phase of the Iruta project that we have, and on 2 new sites that we have now acquired, one of which goes to market next month. For that reason then, if you're saying that I need 20 billion shillings to develop on these 4 sites, of which the capital, the equity requirement is 5 billion, I think there is an opportunity for us to use our capital and some of the assets that we have to catalyze or to try to crowd in local capital, and hence the question of how then do we approach our local capital market. So our pipeline now is about 3,500 units, over and above what we are currently constructing.
Okay. From what you've said, it sounds to me like the ticket size you're looking at in this through this REIT would be something in the order of 5 billion or so.
Yes.
Okay. And I'd wonder about the timing. One is that if you look at the market, was floating a bond ever on the table, only that the yields haven't made sense? And I'm asking this because, as you rightly mentioned in your previous life, you have structured debt instruments, and very well so, and raised capital for real estate. Why not go that route? You're
right. I mean, the current elevated interest rates that we are seeing at the moment would not allow one to practically issue a bond. Even though I think one of the probably easier fundraisers from our pension funds or from local capital is debt, not equity. Equity is always a much more difficult conversation. We've only had one issued bond in this market with housing as underlying. The bond, it was a zero coupon bond. I think the yields were very good from the developer perspective, the 12.5. And I think as an industry, we are very proud that the developer was able to redeem the bond. And not just redeem the bond, I think they redeemed earlier.
Yeah.
than the maturity.
Yes.
But every investor in that bond maxed out on the equity-linked component. And I think what the developer did is to validate that, affordable housing or housing generally can be an investment-grade asset. And that there is an opportunity there for local money to participate in. My sense is with interest rates now coming down as the monetary stance of the CBK gets eased over time, there will still be opportunities to go to market and raise corporate bonds, which tends to be less onerous compared to bank loan raises. We just didn't consider it at the moment because of the elevated interest rate regime that we are currently in.
I see. Considering the kind of backing that you have from external financiers, I thought maybe FX risk could have been a key factor as to why you opted, let's focus on local institutional capital as opposed to that.
It's bad. It's been a bad 2 years. A bad 2 years if you are a foreign investor and therefore your IRR is a USD IRR, and therefore you're targeting a USD IRR, and yet you're investing in a local currency play. Everything we do is local currency. Well, some of our inputs are foreign denominated, but our revenue is local currency. The unfortunate bit then is that you might be doing a very high Kenya shilling IRR, 30% plus.
Well, when you do that.
But when you convert to the US dollar, the whole thing, so you then struggle to meet your investor objectives. It's really been a roller coaster in the last 2 years, with Kenya shilling almost depreciating by 50% at its highest, and there was a lot of concern then that it could even get to 200. I think what it has done, it has impaired that capacity to bring foreign money into Kenya yet for high-risk projects, because there is a very significant risk premium being attached now to the potential or the risk of depreciation of the Kenya shilling. Yes, but yes, it's been a struggle to meet US dollar IRR. Certainly not on the higher sort of 20% plus US dollar IRR. It's been very difficult.
I see. For the route that you're now taking, have you done any, I'd imagine, yes, you have some market sounding, book building, and how is the appetite looking like? And I'm asking that question, Sam, because if you look at where the perceived risk-free returns are, it's quite high. So all other asset classes are really struggling to catch up. Yes.
I mean, at 18% on the bond, I think I would want to load the Capital Markets Authority and the REIT Association of Kenya. They've been very, and the Nairobi Stock Exchange, they've been very active in trying to promote and remessage REIT as an attractive asset class. And there's been a lot of work, at least in the last 2 years, by those three, with some external support on incubating REITs. And therefore, in the last at least 1 year, there's been a lot of workshops to try to educate the market generally, practitioners generally, on REITs, and to try to identify potential issuers with whom they can incubate REITs. And I believe we have about 3 or 4 REITs under incubation. So when RAC, the REIT Association, then talked to us, we thought it's a great opportunity for us to go and explore that potential incubation. So even now, us seeking the REIT license has been part of the incubation process of the REIT Association of Kenya. They've been very supportive. The Nairobi Securities Exchange has been very, very supportive, as has the Capital Market Authority. I think from both the public and private sectors, the commitment towards seeing REIT, grow, being better understood, has been there, and we've put money into it. Now, the reason I think my product in a way would address that yield inversion that we have, because it's a challenge. Today, if you try to raise money at below 18%, why would anyone invest at below 18%? While all I do is allocate to government bonds, which have always been perceived, and it's a perception, not the reality.
Perception, very important.
That they are risk-free. There's nothing that's risk-free. So for that reason, then just to your point, it means if your risk-free instrument is at 18%, then you add whatever risk premium you want to add. A typical market player will then ask for 25% plus. I don't see any asset class today that can easily give you that, other than a development for sale housing play. Now, the model, the way it works, is what makes it attractive, because it means for every dollar of equity I have to invest in housing, I'm able to mobilize $4 of customer deposits, which is free equity, to build. So in a typical play, you would see my equity buys me land, funds the pre-construction program, and funds a portion of the hard cost, while customers fund the balance, 60 to 80%. Because of that capital light play for housing specifically, it means the equity IRR tends to be very significant. And as long as you have the right sales and marketing infrastructure, as long as you have the credibility and customers trust you, and therefore, buy your units, and not only do they buy your units, they then pay over the 2 years. So you first sell, then you develop. It then means you're able to be capital light and then significantly enhance your equity IRR. So a typical residential play, when you are developing to sell or selling and then developing, would have IRRs north of 30%. I don't see any other asset class that can easily give you that 30% today. Yeah. Yes, and I think that's what makes housing very unique. Okay. Yeah.
Sam, do you see a potential perception challenge? And I'm asking that question because the debut REIT in this market is undergoing restructuring, and it has sent a certain view around REITs. And how do you de-risk yourselves from that, now that you're going that route?
And that has been the big elephant in the room, isn't it, for REITs in Kenya. The perceived, and I would say perceived, performance of the first REIT. We always congratulate Raphael et al. As being the people who paid all the school fees for us. And I think a lot of lessons were learned from that first REIT. Not just how it operates, but also which is the right market segment to list in, and who should then be the target sort of players. And my own perception is, or my own view is that most of what that REIT suffered is perception, as opposed to that reality of a long-term, inflation-hedged asset. So yes, I suppose any new issuance will obviously suffer then from that initial perception, and especially by pension funds. It doesn't help that the competing asset is a government bond today yielding 18%. I suppose the next two REITs by ECOL, the D-REIT and I-REIT, in a way tried to address that. I think we could agree they've done relatively well. The asset class is good, and I think generally the overall performance, much as they are continuing to grow at the moment, has been okay, which probably is what encouraged the next one by Lab Trust, and we are now waiting. As they start trading, we are waiting to see, but I also think they have some very good assets. I suppose the market then was ready for a different kind of REIT. If you look at all these REITs, the two of them are specific I-REIT, even the Econ D-REIT, the eventual end game is exiting to an I-REIT. So it's really a yield play. A development for sale housing play is different in the sense that you're exiting this asset even before you start developing it. And within a 3-year period, you're able to realize your capital gains. Unlike an I-REIT where you're holding an asset for a very long period, so that your IRR, your cash IRR is actually realized when you sell after long. A house is pre-sold then built. You build it for between 18 to 24 months, and probably you can give it a year for you to collect all the receivables. So it means within a 3-year cycle, you've realized your capital gains. And then you have an opportunity to distribute back those capital gains plus initial capital, which then enhances the IRR significantly to north of 30%. And I think if you are able to demonstrate to local institutional investors that you can actually be able to do that, either as a case study of projects you've already done, or if you succeed in that D-REIT, actually be able to pay back that capital from the first project, I think in a way it should just go a long way in trying to address some of those initial perceptions, which I believe are wrong. I don't think they are really supported by reality of REITs. Real estate, what people, I suppose, don't do with real estate is realize a government bond and the yields you're getting from it are not inflation hedged. It's a nominal return. And to compare it with a rental yield, you would have to add inflation to that rental yield so that you have a like for like. The rental yield is inflation protected. And one also has to look at the capital appreciation of this asset over the long term. So I think most of what REITs have suffered in Kenya has been a perception or a need to educate a bit more, which I think the REIT Association and the NSC have now been doing and doing very well.
But because of the redemption component of the REIT you're taking to market, then I'd imagine the core value proposition for you guys is not even the rental yield, is the fact that an investor either way would be cushioned, right? It's
cushioned. So I think it's two things. It's high capital velocity, that within 3 years, the capital injected in any unit, in any project, is now available for redistribution. So it's a high capital velocity. You even enhance your IRR the more you recycle that capital. So if I say I want to recycle capital within 7 years, I can recycle it 3 times into 3 projects, now significantly enhancing the return. So there's high capital velocity, but also the very high IRR. The nature of the business model is that because of that equity, customer deposit sort of mix, you are able to give any project can give you a very high IRR at its level, the equity IRR.
When you go to market with a D-REIT, help me understand this, Sam. Are you subjected to for the lack of a better word, onerous dividend distribution requirements that we see with I-REITs?
So for I-REIT, it's mandatory to distribute the 80%. For D-REIT, no, because it's really a development and construction REIT. There's no regulatory requirement for the annual distribution. And I suppose the regulations recognize the development cycle and the nature of developments. So if today you take any D-REIT money, even in housing, even if you pre-sell a house and you take any D-REIT money, the dividend is only available for distribution when you complete the construction and also hand over the unit to the owner after they are fully paid. Then from an accounting perspective, you can recognize the revenue. It qualifies for revenue recognition, and only then can you distribute profit. So even in a play where you are saying, I should be able to be distributing profits every 3 years, after the first 3 years, the reality is that the first 2 years at least, there will be no dividend. However, because it's programmatic, you're not just taking the money and putting it in one project, you're putting it in several projects. After the first 2 years, it means every year after that, there will always be units which have been completed in the previous year or in the same year that are meeting the revenue recognition criteria. So you'll have a certain minimum number of housing units that are qualifying for revenue recognition and therefore for dividend distribution in any particular year. So I would then guesstimate that the first 2 years, no dividend, no capital redistribution. After the first 2 years, every year after that, there will be dividend and capital redistribution. My aim, should the D-REIT be approved by the CMA, should we, successfully do the raise, would be to fully distribute all the profits and then give the owners, the investors, the option to redeem.
I see. But the inference here, the key take home, I think, is that you have some headroom before you start talking about that distribution.
Yes, there's some headroom to just give you that time now to build your program, complete projects, and now start, revenue recognizing them from year 3. Then you can start distributing.
Okay. How does your ecosystem look like, if you can disclose, that is? Who is your trustee and the likes?
So we've been going through the process. I think we have now appointed, all the key stakeholders that we are required to appoint. On the trustee, the market, fortunately or unfortunately, doesn't have many. There are only 2 licensed at the moment. So Cooperative Bank will be the trustee by law. At the moment, it has to be a bank, so it's Coop Bank. Dan Blair have been working with us on the transaction advisory. So they've been working with us on the structuring. The legal counsel have been appointed, and all the other professionals that CMA requires, or the regulations require to be appointed, are now in place. We've been presenting, because we are part of the REIT Association of Kenya incubation, in each of their workshops, we've been making presentations to potential investors and to the wider market. Just to try to, educate them on the product, but also gauge the sort of appetite. Obviously, the issuance is subject to CMA approval. So we are now going through that process of getting CMA approval.
Okay. In our first conversation, Sam, it was dominated by the discussion around just how far the Kenyan real estate market was from institutionalization, if I could call it, of capital coming in. Given what we're seeing now from Vida, is it a signal that in your own assessment, the real estate market is now ripe, has now come to maturity for institutionalization of capital?
That's a good question, and it's been a concern. I remember the earlier comment we made that no one player, certainly on the residential, actually on any market segment within real estate, no one player can say they control 1% of the market, or even 0.1%, and it reflects how fragmented the market is, or the wider industry is, and therefore how uninstitutionalized it is. I don't think one can count, especially on residential, more than 10 institutional quality developers. And therefore there has always been that need for, let's see, more institutional sort of developers come up. And that would help in building credibility, which has been impacted previously. You know, when some individuals formed companies, collected a deposit, then, you know, did whatever they did. So I think in trying to build that credibility within the industry, we've always been very keen to see institutional quality developers, very well governed, come in. But I'm glad to say, if I look at the last 10 years, we then have seen a lot of now institutional quality residential developers, but other developers coming in different asset classes. So I would say on a maturity, sort of a capability maturity model, yes, we are now moving towards the right direction, but we are still far. We are still far. We are, other than a few private equity, external, other than one listed player, I don't think we are still seeing a lot of institutional capital moving specifically towards residential. On other asset classes, probably, to a large extent, especially commercial office space. But on residential, it's still on a very lower scale, if you ask me. There is more, and yet it's really an attractive market opportunity.
And to that point, again, let me go back to our first interview. I asked you this question. The residential market in Kenya is dominated by this consumer habit where I know a small developer, I've seen them do houses. I might not want my Vida. I want that guy because it's relatable and we can easily engage. And I asked you, do you feel you might be in a market where you are not well placed when you focus on residential? When you look back 2 years down the line, how has it been?
And you're right. If you think about who our competitor is, the real competitor, is not necessarily the other bigger institutional developers. No. It is, to your point, Julian and Samuel now doing another block somewhere and being able to sell to their friends or to whoever. And because at the moment, the whole concept of institutional developers and me relying on those institutional developers in paying my deposit has not at least developed to an extent of a very developed market, I would say it has remained then, should I call it a business risk? That if you ask me who's your biggest competitor, I wouldn't necessarily point to the next large one. I would probably say the next development, whoever is developing it, whether it's Julian, whether it's Samuel, or another developer. And I think the market, by its nature, might remain fragmented for a long time. But you know, I think now we are seeing a number of developers who can claim to have done 5,000 plus or so units. I think because of the credibility issues we've seen in the market, we are now likely to see something similar or equivalent of the flight to quality. And in a way, I would say we've benefited a lot from that, where people sense, you know, you are credible, you are backed by institutional capital, so we can rely on you to give deposits. My own sense, you know, to the extent that you're collecting a lot of billions from people on the promise of building, we are, in a way, public interest entities. You are collecting public funds. And I think with time, because of the issues we've had previously, customers are now realizing the need to work with credible institutional developers and shy away from now these individual and institutionalized people. But they do remain. I think, you know, my competitors today would be they, from a development perspective, but also interestingly, unit trust funds. Because, you know, I shock people when I say I do consider other savings options as a competition, simply because a typical buyer is an investor buyer. It's just a person, it's just, you know, it's Julian allocating capital from one savings or asset to real estate. So if you have 10 million, you are trying to choose between me not necessarily between me and another developer, but between me and another opportunity. So that opportunity that you want to invest in becomes a competitor to me.
Okay. As we wrap up our conversation, one is, let's talk about now the macros. For a long time, especially when it came from COVID, we were discussing real estate and off-take risk. Is it still a headache? Or such a big headache?
No, it's interesting. It's good to bring out COVID. If I remember the COVID years, by Q4 of 2020, so what happened initially, there was significant shift to unit trust funds and savings accounts. So you saw a significant rise in balances held by banks in savings accounts and deposit accounts and in unit trust funds. By October, still under lockdown, there was significant sales by the large players. I think a good number of us were reporting an upsurge in sales and an upsurge in collections. And I think in a way it points out to majority of us don't sell homes. So in fact, sometimes I think the Vida Homes name is misplaced. We do not sell homes. We sell investment opportunities. It's just another savings avenue for your typical buyer, because your typical buyer is really trying to preserve wealth. They want a balanced portfolio. They have allocated capital to maybe equities, money market funds. But for long term, they want to allocate some capital to preserve their wealth, because real estate is the one way you preserve your wealth from inflation. And therefore, it's an investment decision as opposed to a spending decision to buy a home, which is then why, in a way, we've been able to ride through economic downturns, because your typical buyer is a person who's been saving for a while and already made a capital allocation decision sometimes back. For generally, then in housing, we are able to ride, the economic downturns and the economic ups and downs.
I see. Now, my final question is this. In the present macro environment, where we have elevated credit risk, if you look at banks and their non-performing loans, they're really rising. One of the books that shows the greatest vulnerability is normally the mortgage book. Is it showing up in your numbers? Are you affected by that?
If I look at our completed project, less than 10% of the sales were to mortgage buyers. 90% was primarily to investor buyers, and as is typical with our industry, they were cash buyers, or they were funding their purchases from savings. So to that extent, I wouldn't say then, from our perspective at least, that we've seen that. We haven't really seen any mortgage distress, at least on the customers that used mortgages to buy our units. In any case, I would say, looking at the completed projects, it's now, I believe all our customers have, or our buyers have finally rented them out, and they're able to generate their yield. The asset has performed quite well for people who bought initially. I think the level of repeat buyers, number one, and the level of new buyers that you're able to generate. Since we met, I think our sales have been up 10x over a 2-year period. Our sales have grown 10x, meaning also the customer base has grown 10x. What I see is from every project you move from one project to another, you do tend to have a very significant level of repeat customers. So I haven't seen the macros generally affecting certainly real estate residential. Granted, of course, we are going through some economic headwinds. I think one cannot ignore them. And sometimes investment decisions are very much also about the perception of risk by the investor and their view of where then should I place my money to ride through what is a perceived, economic distress. And for that reason, I think the market generally, from what I hear from my peers, there's probably been a slowdown. I haven't seen it significantly. Our sales continue to sell. As we were discussing earlier, since we met, we've launched 4 new projects. We have about 840 today under construction. We are about to launch 2 new projects outside of Garden City, and the market appetite for that has still been very good. I think I would attribute it to the extent that it's a saving decision. You don't talk to people who are necessarily looking for new capital to save. It's people who've been saving. And therefore, more likely than not, they are reallocating capital from an asset class to real estate. And therefore, in a way that then hedges us from the extremes of economic downturns. Some have asked us, do we see the housing fund being competition? If the government builds 100,000 units, do we see that as being competition? My own feeling, other than the philosophy of having to pay the housing levy, a housing fund in itself is not a bad thing. And I think what the government of Kenya is creating is the single largest, could end up being the single largest housing fund in the continent, given the level they collect. To the extent that the deficit is very significant, and they are primarily addressing, or are supposed to address, the lower middle class and the low-cost housing, we are then competing in very different segments. Even what we call affordable housing, I think it's what is affordable to the middle class, because it's the 2 million, it's a sub 10 million. I don't think the government is necessarily a competitor in the middle class, or what is affordable to the middle class. My own view is the success of that fund, its very long-term success, would be institutional off-take arrangement with private players. Give me a book order to build for you 10 billion worth of assets. I know you have the funds. Then I will build. And I will achieve the same thing you are trying to achieve in terms of job creation and creation of the economic opportunities. And I hope with time we will see that institutional offtake come to play. So I don't see the fund as a competitor. I see the fund as a potential partner for our industry in the medium to long term.